Thank you so much, Laura. The topic of today's conference, data and the changing economics of knowledge production by you, is very exciting. We are happy to listen today to you. You are professor, of course, of finance at Columbia University, a graduate school of business. I very much recommend to actuaries and the insurers who are listening to you your last book on information choice in macroeconomics and finance at Princeton University Press. Laura's most recent work examines the data economy and the value of data as an asset. I would like to thank so much, Laura, very much for having accepted to deliver this conference that is for us very meaningful as the foundation, the SCOR Foundation for Science, because we are supporting scientific research on risk and insurance. And as you know, or may perhaps not know, information is absolutely key for insurance and reinsurance. A risk on which we have not been able to gather information is not really a risk. It's a radical uncertainty, certainly, or a product of our imagination. In any case, it is not something that can be insured because if you cannot describe the risk, if you cannot quantify the exposition to the risk, and my client as myself, we cannot price it by definition. Data is therefore a key asset for insurers and reinsurers, and how to acquire it by ourselves or by turning, for example, to GAFAs is a key strategic decision for insurers and reinsurers. At the same time, protecting the acquired data, especially if it concerns personal data, is not only a regulatory requirement, but also a part of good enterprise risk management. Actuaries are at the heart of this data acquisition in our industry, acquisition, exploitation, and protection strategy. Again, actuarial science and economics are converging on this topic as in all different topics. So thank you so much, Laura. And perhaps I let know Gilles introduce you more academically and less with link with the foundation and the insurance industry.
Okay, thank you very much, Philippe. Well, we are very honored and delighted to have Laura give this year's annual SCOR PSL lecture. She has published in all the top great journals in our discipline. And in particular, I'm going to talk about SCOR again, Philippe, because her work is especially relevant for our partnership on macroeconomic risks. She has written many papers, important papers on information in macroeconomics. She's at the crossroads between economics and finance, and she has also worked a lot on the role of uncertainty shocks, changes in uncertainty, a topic that we have discussed pretty regularly in the context of our activities. As far as I can tell, today's presentation is equally important and topical, but it's slightly different. We are in the context of the recent developments on automation, on robotics, where there's been a lot of talk about robotization, automation, human replacement, the role of artificial intelligence and stuff like that. And Laura's contribution is about one even more recent development of those in this area, which is data, which is big data. It reminds me a little bit of a complicated paper by Sachs, Kotlikoff, and co-authors, where there is code in the production function and where skilled workers produce code, And that's a mixed blessing because they compete with themselves. It's like a durable good monopoly. They compete with the existing code that is floating around and that has been produced in the past, and they get a number of results that depend very much on parameter values. In particular, improvements in information technology could be immiserizing for various reasons. It could lead to reduction in savings and in capital accumulation. So we are eager to learn what Laura is going to tell us about the surge of data and big data in the production process. So Laura, the floor is yours.
Thank you. Thank you, Philippe. Thank you, Gilles, for the very generous and insightful introduction. Give me just a moment to share my screen. Okay. That should be, okay. So this is, I'm going to talk today about the changing economics of knowledge production. And I'd like to point out this is joint work with Simona Abbis, who's my colleague here at Columbia Business School. So a claim that we heard floating around, we heard in the popular press, we heard some economists espouse, is that big data technologies are like the industrialization of knowledge production. This is a claim we want to investigate skeptically. So we want to measure something that looks like industrialization and see. So what does it mean for something to be like industrialization? Well, what's the key feature of industrialization? What was its essence, right? 100 years ago, what was it fundamentally about the economy that was changing? Well, industrialization changed the relative intensity of labor and capital, right? Before industrialization, we had lots of production of goods. Let's say you wanted a cup, you'd go to the tinsmith. The tinsmith would hammer out some tin and make you a cup, right? And there was an enormous amount of labor involved, but some fairly simple tools. After industrialization, we produce cups, but we produce them in a factory with much more capital and a lower labor share of the input. So the question is artificial intelligence and machine learning, I'm going to use AI here as a shorthand, not just strictly for artificial intelligence, but a whole suite of technologies that rely on using a large amount of data. And ask, are these kinds of big data technologies doing something similar? Are they changing the labor intensity of knowledge production? Can we think of knowledge production in the pre-big data era as being workers that are handcrafting models for a purpose, just like the tinsmith would handcraft a cup and bang it out to the size and specifications that you want. And after that, we have instead more data needs, but we have automated the model selection process. And so there's not as much labor that's needed. There's not as much human judgment needed to create forecasts, to create predictions, to create knowledge. So is that a correct description of what's going on? Is this a big difference? Is this maybe just a small change? Is this just another technological innovation, not really on the scale of something like industrialization? These are the questions we want to wrestle with. And this matters because it matters for employment. It matters for inequality. What will be the labor share of income is intimately tied to what is the share of labor as an input into production. It matters for the optimal size of firms. Are we likely to see much bigger firms going forward and a hollowed out middle of the firm size distribution? It matters for competition between firms. All of this stuff is governed by what is the nature of the production process. Okay, so the challenge to trying to figure this out, how is knowledge production changing with the advent of AI and machine learning, is that we're really in the early stages of adoption. There are not a lot of firms overall in the economy that are really using AI and machine learning. They might be experimenting with it. They might be, hire one person, they might try something out, but not a lot of firms are really going into this in a big way. So this is a technology at the very beginning of its adoption curve. But our objective is to try to tease what we can out of the data in a sector that is one of the earliest adopters and try to quantify the impact of these big data technologies. What is this early adopting industry? Well, it's investment management. Investment managers are some of the largest employers of people with these kinds of big data skills, of machine learning and artificial intelligence coders. And also it's a pure knowledge industry, right? They're not using AI and machine learning in order to produce widgets or in order to produce some services or in order to do something else. They're really trying to produce knowledge for the purpose of trading financial assets that has a fairly direct link to profits. So this is the idea, the economy in a nutshell that we have in mind. So we're going to think about an economy where there's abundant raw and unstructured data. It could be harvested from, from Twitter. It could be purchased from satellite feeds. It could be, a standardized data set that one purchases. It could be all kinds of things. But it requires processing. Even if you've purchased a structured data set, a firm needs to process, it needs to clean, restructure, and warehouse that data in order to make it compatible with the existing data set of that firm and make it suitable for their needs. Just like anybody who's ever done research with data knows, as soon as you buy the data set, you are not immediately ready to hit run on your estimation. There's a lot of work that goes in between acquiring and the actual analysis that you do. So we're going to think about a bunch of workers engaged in processing data and turning something raw, unstructured, or maybe structured, but not structured in just the right way for this firm and its purposes, into structured data that's usable for this firm. And then they're going to be a separate set of workers. These are analysis workers who will be engaged in producing knowledge with that appropriately structured data. And we're going to look in the hiring data and identify two types of these analysis workers. Some of them we'll call old technology, some of them we'll call new technology or AI workers. So old technology workers are people who are sort of trained with classical MBA skills. They probably know Excel and Stata, and they do some factor analysis, and they know a good bunch of statistics, but they're not skilled in machine learning and random forests and software packages like TensorFlow that are designed to do modern big data analysis. So we're going to try to distinguish between those two types of workers, and seeing who a firm is hiring will teach us something about what kinds of technologies that firm is using. If we don't see a firm hiring anybody with these kinds of AI skills, we're going to infer that that firm is producing knowledge with an old technology knowledge production function. So we're going to use this simple idea of a production process as a tool for measurement. So it's a very simple model, small number of equations, but the objective is to use that structure to quantify the parameters that regulate knowledge production. There are going to be some exponents in this production function, the old technology one. There are going to be some exponents in the new technology one. And we want to see how much do those change. And that's going to tell us about how did the labor share of income change? How did the nature of knowledge production change? And how much did it change when a firm switches from using this old data technology to the new one? So we'll measure how many data managers, those are the people at this point in the model that are turning raw data into structured data, and how many analysis workers, both of old technology and new technology types, each firm hired, and we'll get from the data how much they pay each type of worker. Okay? So given the quantities and the salaries paid, we can make inference about this piece, right? A major challenge here is no firm will tell us exactly how much data they have. Even if they wanted to share it with us, it would be kind of hard to say, I have this many gigabytes or terabytes or whatever it is, but how relevant is it? How useful is it? What we really want to know is what's the value of this stuff? And so this inference about how many people are you hiring to work with it and what are you paying them will allow us to make inference on really what's the value, what's the quality, what's the nature of this data. And that's what we're going to use to estimate our production functions. So our main result is that artificial intelligence, or this suite of big data technologies, has significantly raised the productivity of analyzing larger data sets. So basically, if we think data has diminishing returns, right, it should, because your first few data points should teach you a lot. If you knew nothing before that, your millionth data point is probably a little less useful on the margin than your second or third, right? That's diminishing returns to data. But AI and machine learning will mitigate those diminishing returns. It makes that millionth data point have a little more marginal value than it did if you were trying to load it into Excel, and it probably would crash your software, right? So that change in diminishing returns is what we're going to pick up when we do this measurement, and it's going to imply a fall in the labor share. And we're going to see that the labor share in investment management for firms using old technology workers relative to these AI workers fell from 18 to 13%, a 5% decline in the share of labor that it gets as income. So this is, if you think of all the value that a firm generates as a pie, the workers are getting 5% less of that pie after the firm adopts this new technology. So this change is pretty substantial. If we compare it to similar estimates for the Industrial Revolution, this is at the lower end. So economic historians have estimated similar changes in labor share for the Industrial Revolution. The very smallest estimates come in around 5%, and the larger ones come in closer to 12 or 13%. So this is at the smaller end of that range of estimates, but still it's within the ballpark of something that looks revolutionary. So how does the labor share fall? Well, a fall in the share that workers get of the total pie of the firm's profits could mean that there are fewer workers, or it could mean that there's just more data and more profits flowing to data. Which one was it? Well, it turns out it's not fewer workers. We're going to see that the labor stock at these firms has been increasing steadily, that the value of data rose an enormous 39% between 2015 and 2018. And that what's happening is that the firms are just generating a bigger pie, more profits, by becoming more productive at using data. So they're not hiring fewer workers and they're not paying them less. They're just generating more total value. And of that additional value, lots of it is flowing to the owners of data. Okay, so here's the model that we want to use to measure. And this is essentially it on one slide. I'll do a little manipulation of it afterwards, but this is the model, whole thing. So knowledge is produced using either the old technology or this big data technology that I'll shorthand AI. So OT is old technology, AI is our new big data technology. We're going to assume that the same data can be used for both. That may sound a little controversial because it would be awfully hard to take a satellite image and load it into Excel and run a OLS regression, right? But one way to think about this is that when we think about diminishing returns to data, remember I was saying that that millionth data point has less value than the second or third one you get. Think about ordering data from the most useful or easy to use to the least useful or the hardest to make use of. Then one way to interpret why there might be differences in the diminishing returns to labor between two technologies is that the old technology basically can't use the millionth data point. It's that satellite image and it has no way to make sense of it. So we're going to say all this data can be used, but it might be kind of useless. It might have almost zero value. So we'll model that as technologies that have potentially differing rates of diminishing returns. So this is a standard Cobb-Douglas production function. Usually we write this as Y, the number of, widgets, or the GDP of an economy has a productivity factor. We've broken productivity into a time component and a firm-specific component. So we want to capture the idea that some firms are maybe getting, or that over time, we're developing better and better AI algorithms. That will be AT increasing over time. And some firms just have better skill at using it. Maybe their managers are more well-versed in this new technology. They can hire the right people and manage them appropriately. But this is our productivity of production. Then we have data raised. This is the structured data raised to the power alpha, and labor. This is AI skilled labor raised to the power of 1 minus alpha. So if alpha here is close to 1, that means data has almost no diminishing returns. That means the first unit of data increases knowledge almost as much, or sorry, the millionth unit of data increases knowledge just about as much as the first unit of data does. But if this alpha exponent here is something like, a half or a third, we've got a lot of curvature in this production function, meaning that the first data point super valuable and the millionth not so much. So this exponent is really telling us something about what are the diminishing returns to data. And likewise, this exponent is telling us, this 1 minus alpha is telling us something about what is the diminishing returns to labor. So we'll allow for the possibility that alpha and gamma are the same. In that case, AI knowledge production and old technology knowledge production are essentially the same thing. And this really wasn't much of a technological change at all. There's a lot of hot air about nothing. But if we find a really big difference between alpha and gamma, we're going to say that's a big change in production technology. That's a big revolution. So not only do alpha and gamma represent the rate of diminishing returns, they also represent the share of that input in production. So if alpha is high, we'll say data is a really important share in production. Firms, it turns out, will optimally use much more data when alpha is high, and conversely, labor will be a fairly small portion of the inputs into knowledge production. Okay, so that's our production function. We have one for AI, one for old technology, and we allow for their productivities and these exponents to potentially be different, but we're going to allow the data to speak to just how different they are. Now, these Ds, these data inputs, that's not raw data. That data needs to be structured, cleaned, and machine readable. When analysts are hired, they're not hired to do the structured cleaning and so forth. They're typically hired to work with structured data sets. So creating those structured data sets requires a different kind of labor. We're going to call that kind of labor lambda. It also has diminishing marginal returns. And then we'll think about a firm I having a structured data set that's, well, this is how much structured data they had yesterday. It depreciated, some of that data, gets stale, or the links break, or what have you. And we'll think about new inputs into that structured data set as being a function of the number of workers in that data management sector that they hire. Okay, that's the whole model. So now we're just going to manipulate it a little bit to make it suitable for estimation. So the first thing to recognize is that data here is a long-lived asset. And so we have to think about this as a value function. We want to use a recursive approach, or a Bellman equation approach, that says the value of a stock of data to a firm is this is the total profits of this firm. Well, this is actually the gross revenue minus their costs. Their costs are labor, wage times labor. So this minus this is their profits of that firm, plus a discount rate times the value of the data they'll have tomorrow. And so from that, we get 3 first order conditions. First order condition just means firms are choosing optimally. And really, that's the key assumption of this model, is that we're going to see firms make some choices. They're going to make choices about labor and about wages. And the key assumption is they're choosing optimally. And what can we learn from these choices, assuming that those choices are optimal? We'll be able to infer a lot. So the first optimality condition says that the total amount paid to AI labor, that's the wage of the AI labor, that's the number of AI workers, so that's the total payments to labor, are the fraction 1 minus alpha of the total revenue generated by AI knowledge. Okay, so that's, I was just describing to you that exponent alpha is 1 minus alpha is the labor share of income. This is saying that comes out of an optimality condition. Take all the revenue you make and pay a share 1 minus alpha to your workers. Same thing with old technology. Take all your revenue and pay a share 1 minus gamma to your workers. Okay, wage times quantity of workers. And finally, it's a little bit more complicated. How do we pay the data management workers? What we pay the data management workers depends on how much the data stock is increasing. That's this dt plus 1 minus dt. And it depends on the value being generated by the analysts who work with the data. So this is the optimality condition for how much should I pay in total to my data management workers. So what we're going to do is observe this object, and wage and labor and wage and labor and wage and labor here. And we're going to use those choices to infer, to identify these exponents, alpha, gamma, and phi. So now, that sounds simple. Let's just go estimate those equations. Let's identify some parameters. How hard could that be? It's pretty challenging. The first challenge is we don't know how much data any of these firms have. We don't see it. Nobody reports it. But we can infer it. And actually, we can infer it in 2 different ways. One way we can infer it is by saying what would be the optimal amount of data for a firm to have if we saw it making these kinds of decisions, hiring this many AI workers and this many old tech workers and this many data management workers. A second way we could infer data is by saying, well, let's make some guess about what we think how much data we think the firm had at the very beginning of our sample. And then let's add to that the amount of data that should be generated by the data management workers hired in the first period, and then the data management workers hired in the second period, and so forth. This is like how economists estimate the value of a capital stock. Oftentimes, we don't know how much the building, if you're sitting in an academic building owned by a university, it probably has never sold at a market price, or probably not, at least within the last few decades. Maybe it's a brand new building, probably not. And if not, we don't have a really good idea of what its market price is right now. And so, how might we think about valuing that building? Well, we'd say way back when it had some initial value, maybe that's the cost of construction, or maybe that's the transaction price from 50 years ago, 100 years ago. But what's all the investments we've made in that building, right? How much did we pay to upgrade the air conditioning system and to retrofit this and so forth? These investments are like what our data management workers are doing. Okay, so this gives us some way of thinking, making inference, making educated guesses based on data about how much of a data stock a given firm has at a certain date. So we're going to there are a couple of different ways to make these guesses about the initial data. We'll do it in two different ways and show that we'll get similar results. So once we do that, once we make this inference about how much data we think each firm has, which is of independent interest, and I'll show you what some of these graphs look like, then we can go off and estimate some of these first order conditions I showed you, these optimality conditions. We can compute the four productivity parameters, the time dependent productivity for old tech and AI, and the firm specific component of productivity in AI. And we use those just by doing cross-sectional averages for each period and time series averages for each firm. So it's pretty easy to make some identifying assumptions to get at these productivity parameters. Okay. So now that I've sort of described you what our basic approach is, before I get into the details of what exactly is the data we use and what we find, let me just give you a sense of where this lies in the literature. So what we're doing is pretty similar to what people who think about intangible assets are doing. So these are folks who are thinking about customer capital, they're thinking about organizational capital, they're thinking about the value of brand, all kinds of assets to a firm that are really valuable, that contribute to their market value, that contribute to their profitability, but they're really hard to assess, you can't put your hands on them, and they're hard to measure in value directly. And so what they often do is use a structural approach like what we do to try to measure them. And so we're coming in with a different kind of intangible asset. It's a very important intangible asset. Data is the most valuable asset that some of the largest firms in the modern economy own. But also we come in with a different approach, because not only can we not really value that stock of data, we can't even see the stock of data that most firms have, but we can see that there's specific skills that workers need to have to work with data in a particular way. So, this is a little bit different, because when people who estimate, customer capital or brand management, they often don't say, well, I need exactly this kind of worker skill, and how many of these workers are they hiring? So this is this labor-based approach works pretty well for data, because we'll show you there's some easily identifiable skills that go with data jobs. This is certainly related to work on information and financial markets. What's different here is that most of these theories equate data or signals and knowledge, right? They say once you see a signal, you update your beliefs, usually by Bayes' law, and then you go off and make better decisions. And here we're saying, well, actually, there's a lot of work that goes in between seeing some piece of raw data and then making an informed decision based on it. And so we're sort of unpacking that middle ground. And lastly, this is related to, I think Philippe mentioned the relationship between this work and his introduction and work on AI in the labor market by people who are thinking about things like robotics and automation and so forth. Our research approach is very different to theirs. They mostly use a difference in difference approach to measure labor changes. So they'll say, something changed about the environment, some regulation changed, some new technology was invented. Let's look just before and just after for firms that did this and don't do that and so forth. We're taking a more structural approach because there's no natural difference to use that will clearly identify the structural parameters that we want of our production function. Okay, so what's the data? Our job postings come from Burning Glass Technologies. We've filtered these extensively to select out investment management firms. The way in which we identify these three different kinds of jobs is pretty crucial to our estimation. And there's a lot of work that went into it. I'm going to relegate a lot of those details and send you the paper to look at, but I want to show you these these three word grams to give you a sense of how these jobs differ. So on the left here, we have words that show up in job postings that we call AI job postings. That's our little robot here. So it's things like machine learn, data science, analytic skill. There's some math, there's some natural language process, and so forth, right? So they're a set of words. Now, some of those words you see showing up here, like portfolio manage, also show up here, portfolio manage, for old tech workers. But there are a lot of words that are different, or that are different in frequency. So an old technology worker would have a lot more emphasis on statist and math and financial model relative to these workers that will have emphasis on different sets of words. So we look at word frequency. We don't just say if a word shows up once, you're definitely in this bin. We create probabilities that each job posting belongs to each one of the three categories. The easiest to identify are the data managers. They have very different skills than either of these two kinds of analysts. They're more likely to say, the job postings say something like data quality, SQL server, data govern. In here, there are a few mentions of specific kinds of software they use. Those show up in here too. Things like, Hadoop and TensorFlow and so forth. Okay, so that's how we sort these jobs. We're using a language processing algorithm based on the frequency of words for each job category. And we did a lot of checking after the fact to make sure that our algorithm was doing a good job. So what is actually, I'm gonna, given our time, I'm gonna just show you what some of these job postings look like. Okay, so here's an example of an old tech quantitative analyst. So this turned out to be a job posting from 2 Sigma in August 2010. So this is an investment management firm, and they wrote, "We're looking for world-class quantitative modelers to join our highly motivated team. Candidates will have exceptional quantitative skills as well as programming skills. They'll write production quality, high reliability, highly tuned numerical code. They should have a bachelor's degree in mathematics and/or computer science, maybe a hard science, 2 or more years of professional programming experience." This is pretty high tech, right? So we're choosing one that's kind of close to AI. But what it doesn't have in there, it has strong knowledge of computational numerical algorithms, linear algebra, statistical methods, large data sets, but it doesn't have anything that says machine learn, doesn't have anything that says AI, doesn't have anything that says random forest, it doesn't have anything that says TensorFlow or any of the sort of keywords of either software or skills that would be specifically associated with machine learning types of skills. So it might be, this, if you have a computer science degree, you might have learned this along the way, but the job doesn't seem to require it. So we're not counting that as a machine learning job or an AI job. This is what an AI job looks like. So again, this is from 2 Sigma. This is a posting from 2 years earlier. We are looking for talented researchers who can apply and develop machine learning algorithms for financial data sets. That's a machine learning job, right? So it's quite clear that that particular skill is required. And then there's a bunch of other stuff about, the education you should have and, some particular software you should have and expertise in statistics and so forth. And here's machine learning again. It's very clear that they want that set of skills. So that's what we're going to put in the machine learning bin. And then this is what a data manager looks like. So software engineers at 2 Sigma build what the organization needs to explore data's possibilities and act on our finding, to mine the past, attempt to predict the future. You will be responsible for the following: capturing and processing massive amounts of data for thousands of different tradable instruments, including stocks, bonds, blah, 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 blah. Right? So this is somebody who's not doing the analysis. They're not asked to do financial modeling. They're capturing the data and organizing it. Okay, so now that's how we see job postings.
Actually, Laura,
Yes,
can I ask a quick question on the data?
Yeah.
Did you say what is the time frame? I mean, because you showed something from 2010 and something from 2019, and I was wondering that most likely this is not balanced over time, right? You must have a large increase in the ads for more machine learning.
Absolutely. So we have some data that goes as early as 2010 that we only use for burn-in purposes, for sort of getting the right initial conditions. And then we don't actually start estimating anything until 2015. 2015 is about the time that the artificial intelligence algorithms can figure out that a picture of a cat is a cat. Before that, they can't really tell a cat from a dog, from a tree, from a car. They certainly don't pick financial assets very well. So, at that point, there were some big breakthroughs. It was actually a little bit after that, but you'll see in the data I'll show you in just a moment, an enormous takeoff in hiring. There's very little AI hiring in 2015 or earlier, and we see an explosion. It's still a small fraction of all hires, but an explosion following that right in this time frame we're looking at. So really 2015 on is where the action is.
And a related question, like if I am HR and I want to write, the information about the position, don't I have an incentive to always ask for someone who actually knows about machine learning, because I think that maybe I'm not there yet, but I'm going to get there at some point? Would it bias your estimation? Or?
Yeah, so we see some of that where firms are posting a small number of job requests for somebody with these kinds of skills. It looks kind of like experimentation. And then we'll see a small number of firms that are hiring a large share of these guys. So it's going to be very asymmetric with a lot of dabbling. And we can tease that out of the data as well. Okay. That's exactly right.
Thanks.
Sure. Okay, so the data that I've been talking to you about are job postings. That's somebody who wants to hire a new worker, right? That doesn't tell us anything about how many workers they already have. So we're going to have to accumulate up those job postings. And this is where we want to go back in time and use some of that older data to try to build up to how many workers do we think that they have today. So we also have to account for the fact that some workers leave. That's a job separation. Some posted vacancies are not filled, right? Two Sigma may be saying we'd like to hire a machine learning person, and maybe they're not able to. So we have to adjust for the filling rate. So we'll say the stock of labor, this is AI skilled labor, is 1 minus the fraction of people who separated from their jobs times the labor in the previous period. So that's the workers they hired last year, but that didn't quit or get fired, usually quit. Usually they get hired. In this sector with these skills, usually they're getting lured away by higher wages, plus the number of job postings, that's the J, times the filling rate, right? So not every job posting will be filled. So if the filling rate were 2/3, we'd only count 2/3 of the job postings as being actual jobs being hired to that stock of labor. We'll do something similar for the old technology and the same procedure for the data management workers. Now, the trick here is what's the initial stock of labor, right? We need some initial number of workers to start adding on more and more workers. Okay, so the baseline is we could start all initial employment at 0. That's a very conservative estimate. It'll give us somewhat downward biased estimates of how many workers they have. We could also assume that the sector, 8 years prior to our estimation, was in steady state, meaning that they're only hiring as many workers each period as ones that they lost due to separation. That would be a bit of an overestimate. It's saying they're not really growing their labor stock in any of these categories at the moment. They're just stable. So one's an overestimate, one's an underestimate. The nice thing about starting counting jobs in 2007 is that after 8 years, if we take the low estimate of initial conditions and the high estimate of initial conditions, we get about the same thing 8 years later. So neither is exactly right, but they converge. So that's the sense in which this is a burn-in period. So in both cases, we use 2010 to 14 hiring data as burn-in, and then we start our estimation in 2015. So this is what the stocks of labor look like. So this is nothing about data yet. This is just how many workers do we think the firms in our sample have. The top job category is actually data management. There are loads and loads of workers hired to maintain data sets. They're very clearly identifiable, and there are many, many of them. Followed by old technology, followed by, this is the AI skilled worker. And this is what I was talking about with Excel. We can count the workers, the jobs posted pre-2015, but there's almost nothing. So here on the right is exactly the same blue line, just on a different axis, because this looks almost like 0 all the way through. We just blown it up so that you can see exactly what's going on. So, it's creeping up a little bit here, but this kind of hiring really sees a structural break. It starts to explode in 2015. And this is about the time where there are big technological breakthroughs in deep learning. Okay. So between 2015 and 2018, the sample that most of our results are based on, AI employment rose 13-fold, right? So that's an explosion. So this is the wage data. This is crowdsourced salary data from PayScale. They offer detailed salary information at the industry level, job title level, and by skills mix. So let me take just a minute and tell you about PayScale. The idea behind PayScale is they'll offer the service to a worker. If you put in your current job title, and the mix of skills you currently have, we will let you know if you're underpaid. We will advise you on what additional skills you might acquire in your current function that would boost your salary, and so forth. So workers really have an incentive to reveal truthfully, because then the information that they get back is of the most use to them. So in this
sounds
data
very
yes,
seasonal.
it's very seasonal, very
Seasonal
evolved.
fluctuations, no?
There is a lot of fluctuation, yes.
So you are well advised to take a job in March or something like that, no? Or March and September, no?
Yeah, we certainly thought a lot about, whether we needed to smooth this out, and what.
But the unsmoothed data are very useful for young graduates, because
well, despite all this volatility, I see a very
worth waiting for the peaks. You should turn down every job that you are offered to wait for the peak in wages.
Unfortunately, there are some outliers in this sample, right? If you're a very senior manager who just entered in your salary and makes many times what most of the workers that have AI skills,
or maybe it's a composition effect driven by a handful of firms that hire twice a year.
Yep, that's up, and we'll see a lot of tail behavior. There are a small number of firms that gain an extraordinary amount of value from their data sets, and their workers generate a lot of value. But there's still a very clear takeaway, which is that the AI workers, in almost every case, tiny little exception here, make a lot more than their old technology skilled counterparts. So I think this was $22,000 on average in additional pay that these workers get for having these skills. So in that sense, this group of workers, it's a success in the sense that this group of workers that we've identified as being distinct from this group seems to be pretty distinct. At least they're getting paid a lot more. Their employers seem to value them. So, what exactly that number is, yeah, it's a pretty volatile series, but it's certainly different from this one. So that's how we think about, that's our source for getting wages. We are going to have to worry a little bit about the volatility, and there's a good amount of smoothing that goes into at least some of the estimates that we do to make sure that it's not driven by the monthly ups and downs. So from the model solution, those equations I showed you right at the beginning, we have 4 times 3,392 equations, right? Because that's how many firm months that we have. And for each firm and each month, we're going to say they should be behaving optimally in the amount of data they have, the number of AI workers that they hire, the number of old tech workers they hire, the number of data management workers they hire. So each firm month has these 4 conditions. We've got lots of firm months, lots and lots of moments that will help guide our estimation. So our procedure is simply to use nonlinear least squares to iterate over different combinations of these return parameters. These were the exponents in the production function that told us how much diminishing returns was there to data or to labor, and the average initial data stock. Okay, so how much data do we think the average firm has at the start of the sample, right? We needed some initial conditions to build up our data stock. So in each iteration, we back out the production parameters, the productivity parameters from the cross-sectional averages and the time series averages. These are these A's, these time productivity terms and the firm-specific productivity terms. Okay, so we have an algorithm to back those out from the data, and then we use nonlinear least squares to get these 4 objects, the 3 exponents and the initial data stock. And then after we get a solution, we do a broad grid search around it just to make sure that we haven't converged to some local optimum. Okay, so what do we get from all of this? Okay, so these three columns are three different assumptions about the depreciation rate of data, because the depreciation rate here is going to matter a lot. If data depreciates really quickly, it's a much less valuable asset than if it depreciates very slowly. This is a depreciation rate of 10%. This is per month, would mean that by the end of the year, almost all of the firm's data is worthless, right? It has to keep accumulating very, very rapidly to keep up. That may be true for data like order flow data, which is very volatile, but probably not as relevant for, say, customer data. Where do I live? What do I like to buy? 1% per month would be something similar to how we depreciate physical capital, right? That would be a 12% per year annual depreciation. That's kind of similar to how we'd think about a building depreciating. That seems a little low. Data doesn't seem quite as stable and solid and retain its value quite as well as a building, but that will give us a lower bound. Our 3% in between is consistent with how accountants depreciate data. They amortize data over a course of 3 years. So that amounts to about 3% per month depreciation. Okay, so, but we can see for each one of these assumptions, very low, very high, and something intermediate, what do we learn about the rate of diminishing returns to data, or conversely, the labor share?
So delta is a calibrated parameter?
No, it's not a calibrated, well, I guess you could say this middle value is calibrated to how the accountants depreciate data. We have chosen a value.
But I mean, in your estimation, delta, you have to pick delta. You don't estimate delta.
That's right.
Why not estimate delta? It's not possible.
It makes our estimates very unstable when we also try to estimate this simultaneously with these other exponents. And
so why do you have that many equations? Because of D sub I? Because you are treating the stock of data as a parameter in a system of equations?
There is an optimality condition for data.
Yes, but the parameters alpha, gamma, phi are not firm specific.
No, they're not firm specific.
So why do you have to run 35,000 equations times 4?
So I have optimality conditions, each of which is a moment. They hold for each firm in each month.
Yeah, but it's the same optimality condition across firms, no? I mean, the parameters of your model are not firm specific.
That's right. So I don't have 33,000 things to estimate. I have 33,000
lots of observations, but
that's right.
But these are not equations; these are observations.
I'm not sure what you're asking anymore. Could you restate?
Well, in the preceding slide, you say that you are estimating, or maybe equations to be set to 0.
Right. We want them to be as close to 0 as possible, right? Obviously, they can't all be exactly 0 by choosing just 4 parameters. So we're using nonlinear least squares as a way of choosing these parameters.
Suppose that I am estimating y equals ax plus b, right?
Yes.
I want, for each observation, I want y minus ax minus b to be as small as possible, but that does not make it as many observations as observations. There is one equation which is y equals ax plus b, which I am estimating by OLS or whatever. So
so we have four equations that should hold for 33,000 and some observations.
These are the right. You have 4 equations and you have 33,000 observations.
That's right.
Okay. There's no. Okay. Fine.
Okay. So what we find is that alpha is significantly larger than gamma. So here's alpha, and here's gamma. If there's only 1% depreciation, that's a very slow rate of depreciation for data. That's kind of like a building. Then this revolution is astounding, right? This is more than a 20%, 0.2, 20% change in the labor share. That's a lot. If we take a more nuanced approach that maybe data depreciates a little bit faster than buildings do, then we see a 5%. That's kind of the headline result I gave you at the beginning, a 5% difference between alpha and gamma. And if we think that data depreciates almost entirely throughout the year, we actually also get a 5% difference between alpha and gamma. So even if you think depreciation is much higher, you'll get a fairly similar, a little bit smaller, but fairly similar result. If you think depreciation of data is no faster than a building, then that would lead you to conclude that this was an enormous revolution in productivity.
Excuse me, I'm puzzled because I would have naively thought that if you assume a lower delta, you are going to have a bigger D, right?
Yes.
And your alpha is the regression coefficient of output which you measure on D, am I correct?
Well, depreciation will be less, but notice that we then also estimate.
What I mean is that the lower delta, the more you impute of the corresponding input, right?
That's correct, all else equal, but all else is not equal because.
So if you think there is, of course, it's more at the margin, but if you think there is more data, suppose lambda goes up, okay? Then D is going to go up by more, the lower delta.
That's right. But
then if I assume a lower delta, when I see an increase in lambda, I am going to have a bigger increase in D, and the increase in output is what it is in the data, right? So I would assume that dy dd would be smaller, and therefore alpha would be smaller, the smaller delta. Because when I assume a lower delta, I think there are more data around, so there should have a lower coefficient on output.
That's right, all else equal. But what the estimation algorithm sees is you only hire this many data management workers and you only pay them this much. If you think they're generating data that's going to last for 10 years, they should be much more valuable to you. You ought to be paying them more. The fact that you're paying them so little, given that they generate this long-lived valuable data for you, tells me that the rate of diminishing returns on data management work must be lower than I thought it was, right? And that's what brings the estimated data back down. So you've got all of these counter forces in the estimation that make it not easy to think through, right? Okay. So our main the rate, given the rate of depreciation that we have the most faith in, that's most consistent with what the accountants do with other estimates, we find that the labor share fell from 18%. That's the 1 minus this, right? This is the share of income of the firm that gets paid to the owner of data, right? So 1 minus this is the share that goes to the worker. So 1 minus this gives us 18 and change, almost 18 and a half. To 1 minus this gives us 13 and a little bit. Okay, so that's the 5% fall. When this goes up, it means a larger share is being paid to data, but conversely, a smaller share is being paid to labor. So this tells us that the technological change is substantial. So the estimates for the Industrial Revolution are that the capital exponent has risen from 5 to 20%. This is consistent with the lower end of those estimates. If we can talk about that.
Sorry,
yes,
sorry, Laura.
Yes.
Sorry, Laura, it's Philippe. Could you just say a few words on data management? Because the figures seem so strange, in fact, where it seems relatively consistent when looking at all the figures you are giving for alpha and gamma, but the fee of data management is just a little puzzling. But I'm sorry to ask that question. Maybe some explanation if it will be possible, but I will not take too much of your time. But
okay, so I agree that these the estimates up top seem to have a clear, much clearer interpretation than the data management share. And the reason that the data management share can go up and down and seems a little unstable, is first we don't observe the data, and so this sort of push and pull that I was describing with Gilles is also affecting the estimate of the data management productivity parameter. So what do I mean by that? Well, when we change the depreciation rate, let's say depreciation becomes less, data becomes more valuable. If data is more valuable, I'd like to, ideally, I'd like to hire lots more workers to generate that data. But if we don't see in the job postings lots and lots of workers being hired, we have to, make some estimate. We have to pull down that estimate of the production function parameter. But when we pull down the estimate of that production function parameter, we then infer, oh, well, the firm doesn't really have that much data. They despite it not depreciating much, they're investing very little in this because hiring data managers, they don't generate a lot of additional data, and so that brings the estimate of data back down and so forth. So there's all this sort of push and pull that makes it not all move in one direction. Does that help to think about this a little
yes,
bit?
it's clear. But one of the consequences may be that the frontier of data management are not so well defined as the one of the old and the new technology, maybe.
The idea that this is less precisely estimated is certainly borne out by the standard errors. That is absolutely true. Yep. Luckily, that wasn't our main object of interest.
Of course.
But I agree with that. This is clearly the hardest one to estimate. Okay.
Thank you.
So I think a lot of people are concerned about new technologies, especially when we start talking about a fall in the labor share. Does that mean that we have fewer workers, right? Well, that doesn't seem to be happening. This is the total stock of analysis workers of both types, AI and old tech. And even between 2015 and 2018, when these firms are adopting AI technology very rapidly, there's still a steady upward trend in the hiring and the total stock of all kinds of analysis workers. So what's going on here is there's this new technology. It involves using lots and lots of data and not as many workers per unit of data, but the whole sector is expanding so that they're hiring more workers, but they're also accumulating even more data. So data is getting a larger share of the pie, but that doesn't mean the labor force is shrinking. It could have, right? That would also be consistent with a smaller labor share, but that's not what we saw happen. So lastly, I want to point out that this is a methodology that can value data. That value function I showed you at the beginning, V of D, is the firm's value of that stock of data. And we've now estimated all the parameters of that value function. So we can say, how did the value of data evolve over time? So we substitute our estimated parameters and we find that the aggregate stock, so this is for all the firms in our sample, rose 39% over 4 years. That's an enormous rate of growth in this valuable asset. And it comes from 3 sources. The first is they're just accumulating more data, right? Now that these big data technologies work better, get more data, hire more data management workers, add more to the stock. Second, they hired more analysis workers. I just showed you that a couple of slides ago. That makes each data point more valuable because you have workers that can work with it productively. And third, firms are becoming more productive at using data. So these are these productivity parameters we estimated. You can see they're trending up for old tech, and they're also trending up for AI. The proportional increase in AI is much greater, but most firms are still terrible at AI. They're nowhere near as good at generating value from AI as they are with old technology. This tells me they're learning, they're experimenting, they're trying things out. There's a lot of heterogeneity in firms. We could also talk about the cross-section of firms for a while. There's some outliers in this, but for the average firm, they're still better off sticking mostly with old tech, but it is converging. This rate of growth is really fast. Okay, so takeaways. We infer how much data each firm has from the workers that they hire. This way of making inference about this unobserved data stock is a new methodology. We infer how much diminishing returns there are by asking what exponent that production function would make these hiring patterns look closest to optimal. And we find that magnitude looks kind of like the lower end of the Industrial Revolution, probably a little less revolutionary, but it's in that ballpark. But this is for knowledge production as opposed to goods production. And finally, the change in diminishing returns is really important because it matters for the value of data as an asset. It matters for inequality. It matters for the share that workers get of income as opposed to owners of data instead of capital now, but similar. And it matters for firm size and competition. So I hope it informs a lot of work to come.
Thank you. Thanks a lot, Laura, for this very interesting presentation. So let me open now the Q&A session. So we'll be happy to take questions from the floor. And if you want to ask a question, you can raise your hand and we will unmute your mic. But maybe I will go first as I'm already speaking and then give the mic to Bayram. So I wanted to ask, so in the end, like data in your model, it works like physical capital. And I was wondering whether like using your methodology, you could, whether you had tried to investigate the interaction between physical capital and data and what kind of sector could be relevant to try to think about this interaction, or maybe it's too early in the technology or.
Yeah, so that's a great question. I think the way that we've seen this play out sometimes is that some researchers, so I have in mind like Eric Brynjolfsson in management or Adrien Matre in finance have been measuring IT expenditures. And that's a particular kind of physical capital, right? Some of it's software, but some of it's hard. You could take the hardware component out of that. That would be a complement to data, right? So some people, instead of saying, let me look at the workers that you hire and make inference about how much data you might have, they would say, let me look at the IT expenditures you're making and make inference about how much data you have. Now, the reason we didn't pursue that approach in this particular project was that we really wanted to distinguish between AI technologies and machine learning technologies and not. And it seems that people use the same computers for both, right? So we couldn't distinguish based on the expenditure. And even if you used a different brand of computer or maybe a bigger, I can't see exactly what the firm is buying in terms of capital expenditures, but I can see with a lot of detail because firms have to advertise publicly, right? If they would post all of their capital acquisition orders on the web for everybody to see, and I could see exactly what they were buying, right? Then it would be more possible to use those kind of expenditures to make some inference about what technology they're using. But we don't get to see that about capital, but we do about labor. The neat thing about labor is that you've got to advertise publicly, usually to hire a worker. And so that gives us a lot of data from which to make inference.
I see. Thank you.
Sure.
So Philippe, you want to ask your question first? And then I'll take Bayram's question.
I think that Bayram Sakir was first, but okay. I will ask. I have just two questions on the definitions. One is, I am not sure to have well understood one slide where it seems to me, but as I have not been able to come back to the slide. It's my question maybe is wrong, but I had the impression to read them that you said that data is not a raw material, which seemed to me some strange affirmation, because in my mind, data is a raw material that I will work out, firstly, because I will clean the data, and this is the job of the data managers, and thereafter, of course, I will exploit all the data, and in exploiting the data, I will transform them. Then I have, it's my first question, is it something I have wrongly understood? What is the meaning? Okay. And my second question was, how do you differentiate between artificial intelligence jobs and data management jobs? Because many, for example, of my actuaries are doing both together. That is, I cannot distinguish the part where they are managing the data and the part where they are doing an artificial intelligence job on the data, because at this point in time, both jobs are relatively mixed. When, for example, I will be much more able to differentiate in the company what is artificial intelligence job and not an old technology job. This is relatively easy. They use, of course, the same computers, but we know about the functions that it's a different job. These are my two questions. Sorry, it's very on the methodology, but it's thank you so much, because it's very stimulating as a presentation, and I would have much more questions, but in fact, for the time being, it's the main.
Thanks for those questions and an opportunity to clarify. So the first, I think I wasn't clear. I think when I wrote on the slide that data is not a raw material, I meant the D that's showing up in that production function. What I meant was that D signifies processed data, and D did not represent the raw data. But if, I agree with you 100%. Okay. There's lots of raw data out there. But I should have been clear in what I wrote. So I think that was just my poor wording. As for your second question, AI versus data management. So in small firms, we see workers taking on multiple roles, right? That's true in all kinds of sectors. And it's true here as well. So some of the smallest firms do have workers that are doing the data management job, and they're using AI, and they're doing analysis, and maybe they're executing some of the trades, and they might be the chief technology officer to boot, right? And that kind of cross broad nature of a job is kind of the nature of being in a small firm. We typically dropped the very smallest firms that had only a handful of if there's just one person who's doing all of this, they're no longer in our sample. And so we tried to focus on some of the bigger firms, and the bigger firms have the advantage that they do have workers that specialize a bit more. And so they, typically the data managers were really easy to identify. They have a very distinct job. They're not doing, portfolio strategy here. They are doing, kind of back office IT work, and they work with different kinds of software and so forth. But you're right, there always can be a posting that requires multiple skills that is crossing these boundaries that we lay out, and then we put a probability on it. We say, which is it most likely to belong to?
Yes, I agree with you. But of course, for some of the persons who are doing an artificial intelligence work are also always doing at least partly the data management work. Even in big companies, for example, we are not a small company, and of course we have data managers, but I know that those who are doing AI job are also doing partly data management work.
Right.
Okay, but it's clear. I see your point.
So I mean, what we're identifying are really the analysts that do this in two different ways. But I guess your point is we could think about there being two different production functions for data managers. They could be the old tech data managers and the AI data managers. And maybe they have different productivities or, different rates of diminishing returns and different, labor shares and so forth. And one could have instead focused on that point in the production, in the value chain, and said, how does AI matter here? That wasn't our first impulse, because I don't think we were so aware at the time that there was a lot of AI going on in data management, but there's no reason one couldn't do a separate project doing a similar exercise at that point in the production chain. And similarly, one could do a separate project, saying how is this playing out in the marketing industry, or how is this playing out at this point in the value chain in this sector or here. So it's really more about a set of tools that could be directed at many different points in the economy. And so I think you're bringing up a very closely related point in the economy that's a different point in the value chain in this sector.
Okay, thank you, it's clear.
Hello. So my question is about basically like your model where your estimates is based on. So the firms are using kind of inputs, data and labor to produce an output, and all decisions depends on that. For me, so you don't have physical capital at all in the production process. And for me, I was thinking, I can think of several examples that physical capital might be important, and it's related to the value of the data. For example, like I can think of an industrial firm where the robots and machines are better. So any data work or any data algorithm would produce more. Or I don't know if data is used with a better computer or better hardware that you can run your analysis. For example, I am running like a data of 15 million observations, so I really need a good computer so that I can have a value from the data. So I cannot run it from my computer. I use another network. So would you think that this might be important, that something will be missing from the model?
There is always something missing from every model. Every model.
Yeah, of course, yeah.
The question is, would it matter? I mean, look, we could start putting land in here, right? Everybody needs space in which to work. We could start putting, office environment measure of, good culture or organizational capital, or, there are many, many, many inputs into a successful firm. We didn't see systematic differences in the capital expenditures between these kinds of firms. I agree with you that maybe the high technology workers might have higher computing needs, although for these investment management firms, I think they're just buying everybody top of the line computers and renting as much cloud computing, space as one needs. For them, this is like, a drop of change in the bucket. Labor costs are very large for them. Capital expenditure costs, in particular IT costs, it's in the budget. It doesn't look vastly different per worker across firms, and it's probably not their primary concern. I doubt that there are a lot of firms in our sample that will say, well, we decided to stay with old technology because we just didn't want to have to buy those expensive, fancy computers that the AI folks want. They're more likely to say we can't afford to hire the expensive, fancy AI workers that are hard to get and have really high salaries. So that seemed like more of a barrier and more of a relevant dimension of choice.
Okay, do you have a lot of firms that are using like the industrial robots and AI combination of them in the sample? Or can
from the job postings data, we did not see any jobs posted with industrial robots in the analysis, among the set of portfolio management jobs that we looked at. I think there would be other sectors where industrial robots could be really important, right? Like a manufacturing sector or warehousing is really booming industry right now. That would be awfully important there. And that might combine with AI. In portfolio management, like what kind of assets do you want to hold, right? We're talking about buying financial assets, probably not a ton of robotics going on there. At least it didn't show up in our job sample.
Okay, I see. So it's not a fully represented. I see. Okay, thanks.
This is not the whole economy. We focused on this particular corner of finance because they're early adopters of AI. And, it's a good laboratory. There's no reason one can't take this methodology in principle to lots of other sectors, but you're going to need slightly different dictionaries, right? So different industries use different words to describe what is somebody like a financial analyst, somebody who takes structured data and converts it into action recommendations. That's not going to be called an analyst in a manufacturing sector or an advertising sector or something like that. They'd use a different word for that. And so you'd have to adjust the vocabulary a little bit when you do the job selection.
Okay, thank you.
Mm-hmm.
Right, so if there are no other questions, maybe I would have a last question, maybe to conclude. So there's one dimension that you really didn't talk about, which was, sorry, just let me go first. But so about risk. So in your value function, yes, there's no risk, and I wanted to have a sense of what is your view on how the usage of data changes risk, maybe risk management for companies.
Yeah.
Maybe particularly for the SCOR.
So almost every other project I have about data says risk is really important. You can't neglect risk. It's intimately related with data, except for this one where, yeah, we did sort of brush that to the side. I think the way in which risk shows up is how knowledge is priced. So when I had a production function, that was actually the amount of knowledge that was worth $1. And the question is, how do we think about the pricing that information? And that information has value because it'll allow you to, let's say, buy an asset just before it's about to appreciate. I guess more relevantly today, sell your assets before the market's going to tank, or find the one that's more likely to retain its value and so forth. So to increase your expected profit, but also to reduce your uncertainty, right? And so when I think about how much knowledge is worth $1, there's an expected profit component to it, but there's also a risk value, risk reduction value in there. And so it's really buried in those productivity parameters, those A's. They're actually a combination of productivity and a relative price. And so that's where risk kind of gets buried in the model. It gets buried in the A's, which capture what is the value of a unit of knowledge. And part of its value is to reduce risk. But I agree with you that, as we start to think about how do we measure data and how do we value data, thinking about how is it valued for its ability to reduce uncertainty is really crucial here. And I think that is picked up in this project. It's just not really highlighted in the way that we estimated it.
Thank you. Gilles, do you want to ask your question?
Yes. So basically, you have two alternative technologies to produce the same good, which is knowledge, right?
Yes.
But what I don't get is in your estimation, don't you need estimates of this case? Don't you need data on those two kinds of knowledge, KIAI and KOT?
No, we don't. Once we make inference about the amount of data and we observe the amount of labor, we can compute the knowledge produced by each firm in each month. But that's why this was challenging, because we neither observed the data nor observed the output.
Yeah, I see.
Right, so that's why we needed to know the labor and the wage to make inference about the data in order to compute the knowledge.
So you use the marginal product conditions to impute the knowledge.
That's exactly right. Yep.
And you also, of course, a key identifying assumption is that there is no small L in KAI and there is no big L in KOT.
There's no small a in KAI.
Small L.
Oh, small L. That's right. Yes. Right. That AI.
Because of course, another model would just be that K is equal to a function of D, big L, and small l. Right. There is only one production function.
Right. So we saw those two ways of producing knowledge as being substitutes and not complements. That the person using TensorFlow and doing deep learning is not a complement to the worker who's using Excel and doing, risk factor modeling. That those are two substitutable ways of generating a portfolio trading strategy. So yes, we took that stand on, neither is exactly right. Like I said, every model's wrong, but we thought that that was a little closer to the truth than, we did not hear a lot of stories about these two types of workers working, together to try to refine each other's work. They seem to be in separate teams.
Okay.
Philippe?
Just a very incompetent question is when I am using a production function, most of the time I will include some productivity assumption and some productivity variable linked to time or something like that. Here I don't see any productivity appearing in your function. Maybe it's because you did not you did not point on it, or is it because you don't think it is a useful concept in that kind of analysis? Because, for example, part of the question of risk, and when you said, of course, the value of risk reduction may be if the cost of producing this value may be reduced, then of course I have inside the question of productivity, and you could be able to combine, of course, more data and less workers with some gain in productivity by using better IT equipment or something like that.
Okay, so maybe can I put the slides up one more. Let me just show you where productivity was, and then we can talk about whether this is what you had in mind. So these were our two knowledge production functions. So this capital A and little a are both productivity terms. One is saying that all firms are getting better at using AI over time, or I shouldn't say, we're not assuming it's better, but there could be differences in how good they are, all firms are at using AI in, let's say, 2015 versus 2020. And this little a term says that, you know, Goldman Sachs may be much better at using AI than Two Sigma, right? So this is firm specific. And so both of those are showing up in both production functions. So there is a productivity term in there.
Okay, and especially in the big A, which is function of time, then we can see a productivity. Okay, then
yes,
fine
yes,
for
right.
me.
And so then we estimated that and found productivity was going up over time.
Okay.
Okay.
All right, so I think it's time to end the event. So Laura, let me thank you again for giving the lecture. It was really extremely interesting, and I was very happy to learn from you again. And that's it. Thanks a lot.
Thank you. Thanks to everyone who showed up to listen and all the good questions. Be well.
Thank you very much.